Welcome back, accounting boffins, right? Just a quick reminder, we're busy with inventory systems, and the two systems that we are dealing with will be one, the periodic inventory system, right? And we know that when dealing with the periodic inventory system, we said that we've discussed certain characteristics of the periodic inventory system, and we've dealt with the fact that you will notice we spoke about actual comparisons between the two systems, right? And then we also discussed the perpetual inventory system, that's this one here. Both of these are stock systems or inventory systems that we use. Let's continue with our discussions on the two stock systems. Right, with regards to the periodic inventory system, we know that a purchaser's account is used when goods are bought, right? So that's my periodic inventory system. We also know that when goods are returned, the purchaser's account is credited. In other words, when you buy the goods, you debit your purchaser's account, and when you return the goods, you credit your purchaser's account. So what do you remember from this year? Periodic inventory system, immediately you're working with a purchaser's account. Right, if we now go on to the perpetual inventory system, that's this one here, what do we know? The trading stock account is used when goods are bought, and when goods are returned, the trading stock account is credited. So in both cases, using one account, but for periodic, you're using the purchaser's account, and for perpetual, you are using the trading stock account. That should be uppermost in your minds at all times. Periodic, purchases, perpetual, trading stock. Okay. Coming back to the periodic system now, we find that when dealing with the periodic system, your cost of sales is not calculated with every sale or return. In order to determine the cost of sales, a calculation is required. So you do not have a cost of sales account when dealing with periodic. Every time you're selling goods, you're only recording the selling price, right? Cost of sales is only determined when at the end of the month or at the end of the financial year. So that is why, by virtue of its name, it's called the periodic inventory system. Okay, clear? Right, let's take that now and see how it applies to the perpetual system. When dealing with the perpetual system, your cost of sales is calculated with every sale and return. In other words, every time you're selling a good, you're recording the cost of sale. Every time the goods are returned, you're recording the cost of sales. And that is why, when you're working with the perpetual inventory system, whenever a sales takes place, there are two transactions involved. One with the selling price, a debit to your bank, a credit to sales, selling price, and the second part of the entry, a debit to cost of sales and a credit to trading stock, indicating the stock is leaving our business. So, continuous or perpetual inventory tells you two transactions. Whereas, when you're dealing with the periodic inventory system, you sell goods, debit bank, credit sales. Second part of the entry, there's no second part of the entry. You're not keeping a record of the cost of sale. Right, I hope that's crystal clear in your minds. Okay, we move on now to the disadvantages of the periodic inventory system. Number one, control over stock is not very effective. Clearly you can see that, because You're not monitoring stock all the time. You're doing it periodically. And therefore, your control over your stock is not effective. Number two, theft is not quickly detected, right? Theft is not easily or quickly detected. A stock take is necessary to determine leakages or theft. That means you can't immediately identify a stock shortage. You have to take a physical stock take to identify whether there has been theft or leakage of stock. There's no trading stock deficit. That means you can't identify a trading stock deficit immediately. Therefore, the business does not know how much stock they should have. Clearly, this is the case because you're only taking your stock take at the end of your financial year, periodically. And that, clearly you can see, is a disadvantage of the periodic inventory system. All right? When it comes to the calculation of cost of sales, this is important when we are calculating our cost of sales. What do we take into consideration? Right. You start off with taking the opening stock or your stock at the beginning of the year. And this is what we refer to as the opening stock, right? What about the opening stock? The value of the stock at the beginning of the year. Now remember, this is where we are calculating the cost of sale. I'm showing you the various components that you need in order to calculate the cost of sales. Obviously, this is directly related to the periodic inventory system. Right. Number two, your closing stock. This is the value of stock at the end of the year obtained by conducting a physical stock take. The closing stock at the end of the year becomes the opening stock at the beginning of the next year. Let me explain. This year's closing stock, right? If you take a value, let's give it a value and say we had 100,000 Rand worth of stock at the end of the year. That closing stock of this year or this financial period becomes the opening figure for next year. So this year's closing stock becomes next year's opening stock figure. Okay? Then we're looking at purchases. What do we have in purchases? We have the purchases of trading stock for both cash and credit. That means you take into account all the stock that you have purchased. You may have bought for cash, you may have bought on credit. Therefore, you take all of those components into consideration when you're determining your purchases figure. Right? You come to an item called creditors' allowances. What do we deal with here? Remember, we're dealing with a purchaser's account. So whenever there's a return of goods, it means that your goods that are being returned to your creditors will impact on an item called creditors' allowances. Now, a very important consideration here that we have is your net purchases. Okay, when we're talking about net purchases, what are we referring to? We are referring to your purchases less your creditors' allowances. That means, remember, you've bought goods recorded in your purchases account. You've returned goods to your suppliers, so less your creditors' allowances. So remember in your calculation now, purchases less my creditors' allowances to indicate that that was the value of goods that was returned to my creditors. Okay? Then less donations. If there's any donations of stock, clearly it comes out of your purchases account, meaning goods are leaving your business in the form of a donation. Or if you have drawings of stock, that means if the owner takes stock for personal use, yes, The debit will still be in drawings, but the credit will go to your purchases account. So, what is important to remember here is that whenever you're dealing with any stock matter, when we are using the periodic inventory system, right? Let me repeat, whenever we are using the periodic inventory system, you always deal with your purchases account. You always work everything, all your calculations regarding stock are dealt with in your purchases account. Okay. Then you come to net sales. What do we refer to as net sales? Net sales will be your sales less your debtors' allowances. Okay? In other words, you take your sales figure minus your debtors' allowances will give you your net sales. Okay, so this is how we now calculate our cost of sales. Watch. You start off with your opening stock, right? You add your purchases, right? You add your carriage on purchases. Now be careful here. It's not only carriage on purchases, but all other expenses on purchases, like what? Customs duties, railage inwards, import duties, any expense that will lead to an increase in the cost of my article. So other purchasing expenses, you add all of that. You then subtract your closing stock, right? You subtract your closing stock. That will then give you your cost of sales. Once again, this format is critical for your understanding, so make sure you know it. Opening stock plus purchases, right? That purchases figure obviously will be your net purchases. That means you will show a calculation in brackets if necessary. You add your expenses on purchases, you subtract your closing stock, and that gives you your cost of sales. Okay, what would other purchases entail? Examples of other purchases that would impact on your expenses. Let me repeat that. Let's look at other expenses that will impact on the cost price of your purchases, namely import duties, freight, customs duties. Now, here we have, and it's just apt that we're using the color red. I'm going to talk here about a red herring, something that examiners use to ensure that you know the difference between the two. Watch this here. Beware of carriage on sales. Carriage on sales has absolutely nothing to do with the cost price of my good, and therefore it's an item that will go to my profit and loss account. It has nothing to do with the calculation of cost of sales. So if you see it in an activity, in an exam, understand it has nothing to do with the calculation of my cost of sales and will therefore only be used if I'm drawing up my profit and loss account. It's a normal expense like water and electricity. In other words, carriage on sales. Another name for it is delivery expense. Okay, so here, when we come to our gross profit now, it's my sales figure less my cost of sales. Now remember, this figure is calculated. Where is it calculated? It is calculated here. This calculated figure I will slot into my calculation of my gross profit, namely sales less cost of sales will give me my gross profit for the year. Okay? So this you can see now, accounting boffins out there. What's important, if we summarize this segment, is the calculation of your cost of sales. And what is the calculation of your cost of sales? It is opening stock plus purchases, the net figure. That means purchases less creditors' allowances, less drawings, less donations. Right? Add your expenses on purchases, like what? Customs duties, excise duties, import duties, freight inwards, watch out for carriage and sales, not part of the calculation. Add all of that together, subtract your closing stock, and that then gives you your cost of sales. Take that cost of sales, slot it into your calculation. Here we go. Bring in your cost of sales here. Your sales figure, sales less the cost of sales, will give me my gross profit for the year. Okay guys, that's it for this segment. Let's take a quick breather, let's refresh, and we'll see you in a jiffy.